So I'm Yogan, partner at MHA. I head up our sort of life sciences, pharma, and medtech. I mainly get involved in providing advisory services to primarily the SME sectors. So it may be a startup, it could be a scale-up, it could be a large corporate, maybe a subsidiary of an international operation as well. I focus mainly in that life sciences space, but also I have clients primarily in the tech space, some in the consumer and professional services as well. We're really excited to be sort of working with Imperial College. Hopefully this will be the first of a number of events where we will deal with yourselves in various aspects relating to businesses itself. The format of this session today is basically we're going to have a sort of a panel discussion which will probably last about 25-30 minutes or so. It will then be followed up with a Q&A, but obviously if you've got any burning questions, which one or two you may have, then obviously feel free to sort of intervene while the panelists may be talking itself. This is being recorded, so the recording should be made available to you in the next few days, I would have thought. So before I do my sort of formal presentation, a bit about MHA and Baker Tilly, I'd just like to introduce you to my colleagues who will say a few words about themselves. So Lee?
My name's Lee Pimlett, and I lead a R&D and incentives team in the North. I have a background of 8 years at HMRC, training people to do tax, and a further 15 years of being involved in corporate litigation and R&D and incentives work. So sort of feel I have a bit of experience in this field.
Thanks, Lee. So I'm Chris Denning, so I'm a corporate and international tax partner at MHA. I've been at MHA for 12 years now, 35 years in the profession. Previously with the Big Four, always focused on corporate international tax, worked with funded startups through to multinationals, and spent a lot of time doing transactions, mainly on the buy side, which will be relevant to what I'm going to say shortly.
Paul Townsend. I've got a commercial role at MHA in the life sciences team. My background includes working with SMEs for many years, sometimes pro bono. I did some work for the Department of Work and Pensions a few years ago. More recently, I've been working with universities both in the UK and also in mainland Europe. Really everything from market research, articulating what the proposition is, sometimes working with legal teams to understand whether the solution or the science and the research is being replicated elsewhere, and generally acting as a sort of a counsellor. Very much looking forward to the longer term working with all of you. Whether it's face to face or I'm on the end of a phone or a video call. So I'm very pleased to be here today.
Thank you, Paul. So maybe I'll just talk a little bit about MHA. I don't know if anybody's ever come across MHA, but certainly by the end of this presentation you would have heard a little bit about MHA. So MHA, we're a top 13 firm. We've got a good spread right across the UK. Certainly the home counties, the East is well represented. We've got offices in Wales, got offices in the northwest as well, Scotland, and hopefully in the not too distant future, we'll have an office in Ireland itself as well. As it says there, we're about 130 odd partners with 22 offices and staff around the 1,500. It might give obviously a grand sort of view about us, but as I said in my introductions, a lot of our clients are particularly in the SME sector. That's where our sort of sweet spot is. And it will continue for years to come. As Anshu mentioned, so we are part of the Baker Tilly family, and that Baker Tilly family is sort of a top 10 international network. It enables businesses to go right across the globe where they need support. So if you're looking to go into the US or in Latin America or Asia or whatever, through the international network, we can actually support you as you progress. I think the stats are there, and I guess one probably doesn't want to get too involved in 43,000 staff and all that sort of stuff. But the idea behind that is just to let you know that as your sort of startup or if it's a scale-up business, it progresses during its life cycle, then certainly we as a firm can support you in your global journey, if that's what you actually end up wanting to do. We're very much so sector focused, and these are probably our key sectors: pharma, life sciences, technology, consumer, manufacturing, engineering, and there's obviously real estate and financial services. As a London-based main office, I guess, financial services is obviously a key part as well. But there is the other things like agriculture, automotive, which also kicks in the EV side as well. In terms of the services that we provide, we're very much a one-stop shop. The only thing that we don't actually do is provide legal services, but anything else from sort of, starting up your company, setting up a company secretarial, payroll, HR, employment contracts, accounting, audit, tax returns, we do that complete set. Obviously, within sort of companies, you will in due course start doing some tax planning as well, so very much involved in that as well. Lee will obviously talk a bit on the R&D and tax credits and patent box. That's quite a key part. Chris is involved in transfer pricing quite a lot as well. We have a corporate finance arm that gets involved in sort of fundraising. If you're selling your business or you are thinking of selling your business in a few years' time, then grooming the business for a sale, we can support that as well. Some of you may already be getting grants, and then you need to do your reports, whether it's an Innovate or Horizon, etc. We get involved in that part as well. And IP is something obviously quite important to a number of you, I would have thought. And so how that's structured, how you ring fence that, is something we can actually advise on as well. So maybe we kick off maybe just to talk a bit on tax. And Chris, whether you're a startup or a scale-up, I mean, tax obviously is a consideration that one actually has to have. Without going into detail of sort of tax planning, opportunities, etc. In your view, what are sort of 2 or 3 things that businesses should be thinking of as part of their tax strategy?
Thanks, Yogan. It's a very wide question. So for me, I think it's important that a business has a clear commercial objective, and I guess I'm talking to entrepreneurs today who are going to build some value, and I would expect in many situations you guys want to realise that value, which will be in some form of an exit at some point, and during the course of your life cycle you'll be raising funds at various points as well, and all of those processes, whether it's fundraising or an exit, you will go through a diligence process, a tax due diligence process. And I mentioned earlier that I do a lot of buy-side transactional work. So someone like me will come along and kick the tires on your business from a tax perspective, and we'll look at all aspects of that business. So for me, I would start with that mindset if I'm thinking about what is an effective tax strategy. And I think there are probably 3, from a practical perspective, probably 3 key thoughts to have in terms of what that strategy looks like. The first thing I would try and do is get the basics right. And that sounds like common sense, but believe me, the number of times I've seen things at the end of the process that weren't right at the outset, and things like founder shares. If you set a company up from scratch, you'll incorporate it, there's no value there. If you start issuing shares after the business starts to have some activity, there may be value there, there may not be value there. But if you just issue the shares and there's an election that you make that means all of your exit proceeds will be capital, if you don't make that election, it's called a Section 41 election, coming back to getting the basics right. If you don't make that election, then when it comes to an exit, there'll be part of your proceeds will be subject to income tax, not capital gains tax. So things like that. Anything to do with any employment-related share, there's some compliance to be done around it, and it's just getting that right. You'll probably, in terms of attracting people to the business, obviously at the outset, you haven't got the cash, so equity is a good form to get people in, or a value proposition to get people in, and you'll be looking at share incentive schemes like EMI, enterprise management incentives. Now again, you may be able to engage an advisor to do your valuation and to do your scheme rules, but then there's a whole bunch of compliance around once you've issued the options. There's a reporting process, etc. So And if you get that wrong, when you come to the exit, if you haven't reported that the options are issued within the time frame, and I think it's a 90-day time frame, then when you do the exit, someone like me will say those EMI options don't qualify for EMI, and you're back into an unapproved scheme, income tax rather than capital gains tax. So getting those basic things right is really, really important. Things like expenses and benefits. Again, doing P11Ds, doing PSAs, etc. Get it right, because again, those things will be looked at, in great detail when it comes to an exit. Things which I have seen in practice, and you might smile at this, putting personal expenditure or hobbies through the business. Just don't. It's just, it just causes so many issues. Even that boat, yeah. Particularly in technology businesses and pharma businesses, you might employ contractors, and again, the revenue, massive focus on whether you've engaged people on an employed or a self-employed basis. Again, there are things you can do to justify the position. There's an online tool called CEST, where you can look at employed self-employment status, and it gives you some basis on which you can make your decision to determine whether you're going to pay someone gross or pay someone under pay-as-you-earn. But the default position I would always take is, and certainly if it's an individual, if an individual is professing to be self-employed as an individual, put him on the books. Seriously, put him on the books. Where you're dealing with a PSC, slightly different. But again, just be careful about how it's contracted. If you get that wrong, again, it's just going to cause issues on an exit. When you're looking at things like, when you get to say you've done your seed funding, you're looking at Series A, you get your first private equity or VC investor in, they might put someone on the board. How do you engage with them? They might want to be engaged through a PSC, but they're an officer. So some of what they're paid will be subject to pay-as-you-earn. Again, you need to think about how you deal with that. From a part of his earnings might be subject to pay-as-you-earn, part of it might be through a PSC, but if you don't have the right contracts in place, HMRC will view everything that's paid to him as pay-as-you-earn, and again, that can cause an issue on an exit. So just a few things there, and I think the general thing I would say around get the basics right is just keep up to date with your compliance. Your corporation tax returns, your VAT returns, etc. Just make sure everything's up to date, and unquestionable in terms of how in terms of how you dealt with it. I think the second thing I would say, which sort of leads on from get the basics right, is just keep it simple. I think we've all been down the pub and someone's talking about his offshore tax structure, moving my IP to, I don't know, the Cayman Islands or whatever else, and it all BVI, and it all sounds great, but it's not going to work. If you're based in the UK, you reside in the UK, all your substance is in the UK, you're not going to create an offshore structure. So, and again, if you manage to do it and manage to create a scenario where you think you've got an offshore structure, again, when you get to that due diligence process, someone like me will just say, we don't think that works. You've got a 10-year or a 5-year historic risk of HMRC coming along, and it'll be a price adjuster. So just keep it simple. In terms of share structure, I've got one at the moment. I've got a client who's put a remuneration structure in around alphabet shares, A, B, C, D shares. They've got no economic rights, no voting rights, but they've got dividend rights. So their bonuses are paid through dividend, which is avoiding NIC, etc. So, again, someone like me is going to come along and say, guys, we want indemnity for that, or A or B. We think that's a disclosure back to HMRC because you've just avoided, pay-as-you-earn and NIC. So again, just keep it simple. So certainly in terms of advice, and I guess this is a general point. I mean, one of the things I hear from startups often is that we haven't got the money to pay for professional advice, and this is why a lot of these things at the back end of the scenario aren't right from the outset, because people can't afford to pay for that advice, and I understand that. But I think when you're thinking about fundraising, budget for professional fees. Budget for the fact you're going to need some help. and as you go through your growth cycle, as your product reaches some maturity and you're going into markets, if you go into overseas markets, for example, make sure you take advice as you start selling in different territories, because there'll be a point at which you create a tax footprint, and you want to get that point when it happens, not in retrospect, because again that can cause issues. And I think generally from a corporate structure perspective, I don't know, it's nice to have a massive corporate structure, but that takes time to manage when you need to focus on the business, and B, it's expensive. So unless you need lots of companies, just keep it simple. I think it's a key message. And then I think the third point, from a practical perspective, I would always encourage people to do is maximise incentives and reliefs. And obviously Paul and Lee are going to talk about R&D and grants respectively. I mean, those schemes are there to help businesses, they're there to help you funding. So R&D, the R&D repayable credits there to help fund the business at the outset. Grant funding, I mean, grants are available. Please explore whether you can get. I'm sure you are anyway. Capital allowances and patent box, once you start to make money and make profit, again, those allowances are there to minimise your overall tax burden. From a funding perspective, think about your investor base. If you're going out to market and it's UK, think about EIS, SIS, EIS and VCT. Does your company qualify for those reliefs? So as I say, those incentives are there to just try and maximise them. So I think those are the three key things I would say. So keep it simple, or get the basics right, keep it simple, and just maximise what's available from a funding and relief perspective.
Yeah. No, thank you, Chris. And I guess one of the important things when you talked earlier on about is income tax and capital gains tax rates. Yeah, the rate differential makes a huge impact, doesn't it? Yeah,
and obviously we've got a change of government coming up. So I suppose there might be. Obviously, we've got this long-standing relief for businesses, for entrepreneurs disposing of a business called. It's now called business asset disposal relief. It was called taper relief back in the day, and it was Gordon Brown innovation. Innovation, is that the right word? Tax, anyway, whatever. And it used to be quite a valuable relief at 10% tax rate on a £10 million gain, which is £1 million worth of tax relief. Now it's 10% on a £1 million worth of gain, so that the actual the actual benefit's now only £100,000. I say only £100,000, which is a lot of money, but if you're realising 10 or 20 million pounds, 100,000 isn't a huge amount. So probably the more important thing is the rate. A 20% rate is still very competitive, and it's compared to the highest marginal income tax rate, it's 20. That's 45% versus 20%. So one would hope that the 20% rate is something that isn't. There's no rumours that it's going to be tampered with, but we don't know with. And again, without getting political, I'm expecting a change of government, but I might be wrong.
Maybe we'll pick that up. Miracles do happen, right? At times. But over the last few weeks, we've obviously been hearing that the UK has been one of the highest tax rates currently, right? The tax take, etc. But we do get some incentives, right, Lee? And R&D and patent box. And in your view, and in terms of when should a business start looking at identifying patent in its life cycle?
Essentially, I would reiterate what Chris has said. Get a professional involved. Your entrepreneurs, get a professional involved, advisor involved as early as possible, just to enable you to sort of grow. And as you expand, the advice can expand. And if you've got an accountancy firm or a law firm with a wider scope than just the UK, fantastic. That will allow you to you'll get that a natural sort of flow of advice as your business grows. Looking at R&D and patent box in itself, so our R&D is a scheme which is for companies who develop new stuff, pharma, engineering, essentially most areas other than anything to do with the humanities. Again, as a new company, or a new business and an entrepreneurial business, you will usually be developing something new. So you'll be developing a product or a system or a process. And if that development is innovative and has uncertainties, it may well qualify for R&D tax relief. R&D tax relief is very, well, it used to be very, very good. It's reduced somewhat now because of the change in the scheme. But historically, R&D tax relief is worth, if you spend £100,000 on developing a product, you will get essentially tax relief of 25% of your spend. It reduced last year down to 21% and it's now reduced down to essentially 15%, but it's still very, very worthwhile doing. It also has a second strand to what you do. You're a new business. Early on in that business, you need cash. R&D tax relief allows you to tap into tax credits, i.e. the government will give you money back in the form of a tax credit. You're a loss-making business. It was set up for essentially new businesses who are developing new stuff, who weren't making any money in the first 3 or 4 years, and it created a tax credit system for them. So if you're spending money, and you're not making any profits, we will give you tax credits back for you to reinvest year after year. As the process goes along, you then start making money. You start making profits. You're still developing stuff. The R&D then changes from a tax credit into a tax reduction, so it reduces your corporation tax liability. You then carry on. You get to a point where actually you've developed your product and you think, we need to take this to market, or we need to protect it, and then you look at protecting the IP. You then step away from R&D into the patent box scheme. So essentially, you are protecting your product, you're then taking that to market, and you're making money from that. That then changes your records for R&D, then move into the patent box claim. The patent box then claim reduces your tax liability on your profits from that source from 25% to 10%. Essentially, if you've got a £500,000 net profit from a patented item, your tax liability reduces from £125,000 to £50,000. It's a massive scheme. The problem a patent box has is you need to have kept records, because to be able to actually pull a patent box claim together, you need to have kept your development records, your costs. That's where it goes back to the very start. You get someone involved who's going to be able to guide you, who's going to be able to say, start recording this, start your R&D claims. You're building up a record of all your expenditure into your development. You then, at the point where you're selling your development, or you're selling licenses development, or you're actually selling products with your patented licenses in, and then essentially you can then reduce your tax liability massively. There's literally no similar sort of reduction around. You then move from that patent box to actually, we've now got a product we can sell, and where we've got that patent set up in the UK. Are we going to start moving out to the UK? Well, we start looking at states outside the UK. Now, patent box is fine if you've got license, if you've got patents from UK office, European office. But if you haven't got an advisor who's got that sort of worldwide reach, you then look at US. US has different, less strict patent rules. So things you wouldn't get patented in the UK or Europe, you can get them in the UK, in the US. However, that then says actually you can't possibly bring those patents into you can't get tax relief on those patents in the UK. You need to have somebody who knows what they're talking about, basically, and you need to have that structure. Should I use a client?
Yeah.
So if I sort of give you an example of a client very specific to yourselves. This is a Kenyan entrepreneur. She left was in university, come to the university, developed a machine, a robot. She got a funding source from South Africa of £10,000. So she started a journey. From that £10,000, she developed the robot further over two years. She built it up. She got patents in the US for the software, patents in the UK for the machine, and patents in Africa for the machine. She's just sold 20% of her business of £15 million after 2 years. Now she's come to the UK to actually set up a new business, to start again, another product. She needs that constant help to make her understand that where she can maximise tax savings, where she can maximise profits, where she can then bring somebody in to help her sell what they've got, restart again. You really do need, as Chris said, when you set out your first spreadsheet to set up your costs for the start of your business, put professional advice in there. It will save you an absolute fortune 5 years down the line, basically.
And from a practical perspective, Lee, is it easy for businesses to be able to identify their profits to particular patents, because they may have different revenue streams, etc.?
Again, it goes back to being able to, if you've kept a record from the start, the patent box requires you to say, actually, where's your income streams coming from? You need to show your different patents, so you keep records of each product you've got a patent on, and income sources from them, because the calculation requires you to sort of do adjustments. You can't just lump it. You've got to know what your projects are and what your patents are, and and keep records of what the sources of your income are. Because this doesn't cover your whole business. Because if you've got 50% just normal trade and income, you've got 50% patent income, it doesn't cover the whole lot. It literally is what is the income source which is patented.
It is important to keep things simple, keep records,
and that goes back
to be able to.
You keep, from the very start, you keep your development records. R&D actually assists you in keeping those. Make R&D claims gives you a record of all your development costs. You then get to a calculation when you move out of R&D to patent box, and you then have to identify the income streams. But it's really worthwhile. But it's a very hard it's a very hard tax relief to utilise if you've not had the historic records for it, because previously it was possible. Now it's just such a long-winded process that it's virtually sometimes impossible if you haven't got that a core of records, and you haven't got essentially someone advising you how to record your income.
Mm-hmm. And we all know that taxman loves more taxes rather than lower taxes, and looking into people's books and etc. right at times as well.
I don't know why you're looking at me. I don't work for the Inland Revenue anymore.
But Paul, when one's looking to apply or bid for publicly funded subsidies, what are the things that companies should know?
Okay, that's a good question. I think it's useful when thinking about subsidies just to clarify, and you probably all are very clear already, what a subsidy is in kind of legal terms, and it's generally something, if you like, if you're going against the regulations around it, it's something that would give an unfair advantage, if you like. So when governments are looking at a subsidy and whether it's sort of distorting the market. They're looking at things like a subsidy which might be a loan at a below market sort of interest rate, perhaps some sort of guarantee or a tax break of some sort. So that's generally what we're talking about. I think the good news for everybody in this room is that the R&D tax credits, the benefits of Patent Box, don't really fall within the subsidy control regulations. Countries across the world offer similar incentives to the UK around R&D tax credits. One of the things which is really a sort of a mantra around subsidies is there's a number of principles, and the first one that's often mentioned is if it's around innovation, if the subsidy is helping to promote innovation, that's great, because it means you're much less likely to fall foul of any regulations that exist. The main one in the UK came about post-Brexit. It's the Subsidy Control Act, which became law in early 2023. January 23, absolutely. How that's administered is that the subsidies and the monitoring is around the awarding body. That could be a local authority, could even be the university, could be central government. And I guess in a way to stop those awarding bodies kind of marking their own homework, there is something called the Subsidy Advice Unit as an advisory unit. And basically, whilst that can't make a final decision, it provides guidance. And generally, we're looking at the level of subsidies running into many millions. That's when really the subsidy advisory units will take a look at that and provide some guidance as to whether that would be an issue or not. As I say, the wider issue, and we were talking, Yogan and I were talking earlier about the return of UK academia to the Horizon scheme, and EU regulations would apply. So if you're bidding for a public sector contract within the EU, then they have similar legislation to the Subsidy Control Act. So they will look very closely at any subsidies which you as a bidder have received. But as I say, the important thing is that R&D tax credits don't apply, and if we're talking about innovation, again, that's really helpful. It's quite opaque, so the reason I'm kind of skirting around the topic is because for instance, you could be looking at a situation where there's an energy-intensive industry that's bidding, and they may well, for instance, get a huge subsidy to look at green energy production, and that will probably escape the issue of being seen to somehow be distorting a competitive bidding process. So it really, there's a lot of exceptions that really bring in the need for the advisory unit as well. Potentially for private sector tenders in the EU, again, it's possible that a competitor bidder might well raise an issue if they suspect that there's an unfair subsidy that's been received by yourselves, as an example. So that's something to bear in mind. It's quite nuanced, but I think the benefit for everybody in this room, at least, is generally you're looking at leading edge innovation, and most public authorities who would be enacting any legislation look very, very favourable on that. And as I said earlier as well, grants from whatever source, generally, where you're successful with grant capture, again, that is not necessarily classified as a subsidy in any way. The other thing that I was chatting with Lee earlier, a bit of a grey area, is if you're getting two lots of, support, incentives, subsidies, so R&D tax credits plus subsidies, how is that accounted for in a way? And I think it's slightly, I'm afraid, beyond my R&D claim expertise. But, we were almost debating, I think, Lee, as to whether you could have two bites of the cherry, as it were. But I think you had more thoughts on that than I did, I think.
Essentially, under the old R&D scheme split into two distinct schemes. One was a SME scheme, essentially for companies with less than 500 full-time equivalent staff, and then there was a large RDEC scheme which was of a much lower value. So, as I said, the SME scheme was worth about 25% tax relief on your qualifying spend, and the large RDEC scheme was worth about 11% of your qualifying spend, so a massive difference. From the 1st of April to 24, for accounting periods commencing after that, the two schemes have been combined into a singular large RDEC scheme. The SME scheme was always deemed as a subsidy, government subsidy, and in certain cases you couldn't have two government subsidies on the same project. The large RDEC scheme, because it was of lower value, was not. It was just deemed as a reduction in tax. The fact that the two schemes now are being combined into a singular large RDEC scheme, albeit the tax saving is increased to 15%, there is the argument that you can now be claiming subsidies and the grants, government grants and subsidies on the same project on the basis that the large RDEC scheme isn't deemed government grant anymore. So when there was a big furore, as in people like me said, oh, the R&D scheme is losing value, there is the argument that actually it's increased value because you can have multiple subsidies on a singular project. And as the government tries to, we look at free ports and things like that, introduce more subsidies, the tax saving could actually be increased, or the tax credits could be increased as opposed to reduced going forward.
I think a lot of these things are quite complex, right? And I guess the important thing is, particularly with tax, is deadlines, right? And the thing is if deadlines are missed, you lose that opportunity.
R&D sits as part of a corporation tax return. Obviously, you'll sort of all have a very good idea of corporation tax, income tax, and there are deadlines for these sort of things. Under the old R&D scheme, R&D needs to be submitted in line with the corporation tax rules, which were R&D claim gets submitted 12 months after the end of your accounting year and can be amended for a further 12 months after that date. As a way of government stopping what they've seen as some fraudulent action, they've reduced some of these timescales down to essentially 6 months pre-notification. So instead of being able to look back 2 years under corporation tax rules, it requires you now to say you are going to make a claim within 6 months of the accounting year. The days of sort of wanting to retrospectively have a look to see your own R&D claims is gone. The 6 month notification is essentially the government trying to push companies to know they are doing R&D. Goes back to where at the very beginning, you get someone on board who knows what they're talking about, and that is. When I was at HMRC, there was always this thought that R&D would be what's called an above-the-line transaction. So it would be part of your accounts. So your business account would have this credit in, and it would be taxed, and that it would be part of an accounting process and not a tax process. Essentially, nobody the public didn't take up that system, and now it's been forced on us. So now the new scheme makes you look at this as part of your accounts. So the system of looking back 2 years is gone. You've got to know you're doing R&D at the time. So you can't be looking retrospectively at these things. Hence why they've introduced a pre-notification period, which is 6 months after the end of the accounting year, plus forced on you the above the line transaction, which says actually you've got to look at this as part of your accounts and not a post set of accounts tax transaction.
No, thanks, Liam. It's good to hear your insight into some of the tax planning opportunities and things that you need to consider. Obviously, the tax incentives that we actually have and the impact that and interactions with subsidy control as well. I mean, maybe I'll now throw it open to some questions that people may have.